Welcome to the Earn More, Stress Less podcast with me, Caro Sison. This podcast is for self-employed business owners just like you, who really want to grow their business and become successful and profitable, but without all the stress and hassle. I want to share my 30 years of business experience to show you how simple it can be to earn more money and how you can get organised without needing a business degree or any other qualifications. I'll be talking about the easy steps that you can put in place right now to start earning more money today and to help you get the business that you deserve and dream of. Without further ado, let's get started. This week's podcast is sponsored by Pocket PA, helping self-employed business owners to get organised, understand their finances and do their accounts all in one place using a powerful online tool. If you're serious about making a profit and having a successful business, then using a simple digital web app like Pocket PA is the best way to grow and scale your business. Visit pocketpa.com for more details and start managing your money like a pro today. And welcome to the Earn More, Stress Less podcast with me, Caro Sison. Thanks for joining me. So today I'm talking with Jess Walker, who is an amazing financial advisor and owner of Bare Naked Money. And she's been on a couple of previous episodes where we talked about the A to Z of pensions for self-employed business owners, and we also covered off insurances. Now, this week we're talking about income tax and the impact that tax has for both you personally and how it works when you're self-employed. It can sometimes seem overwhelming, but don't worry, we're going to keep it simple. We're going to ditch the jargon and we're going to explain it from scratch. So Jess, hello, welcome to this week's podcast. How are you?
Hi, Caro. Yeah, very good. Yeah.
Fabulous.
All well here.
So my dad used to say only two things are certain in life, death and taxes. So taxation, everyone loves surprises, but no one likes nasty tax surprises. So let's start at the beginning. If there is even a beginning, where do you start at the beginning to talk about taxes, Jess?
So literally at the very beginning, what is income tax? What are the bands? How does it work? So everybody gets what they call a personal allowance, which currently is £12,500, and you pay no tax at all on that. You then pay 20% tax on anything above 12,500 up to 50,270. And then you pay 40% tax above that. But if you're doing that in your first year, hooray. So national insurance sits alongside it, and there are slightly different bands. There's a £5,500 band to about a £48,000. And it's just another sneaky stealth tax, but we'll come back to that one in a minute.
So national insurance, that's what they call national insurance contributions, NICs. And when they say contribution, that's very loosely termed because it isn't a contribution that's voluntary. It's something that's, yes, I love the way that they call it a contribution, if you've got an option.
If you don't work or don't actually earn it, you can pay them voluntarily. But yeah, no. So as a self-employed person or an owner-director, you pay them either on your PAYE as an owner-director or as a self-employed sole trader. They come up with your tax band at the end of the year. When you do your tax calculation, you pay class 2 national insurance contributions, and it's lumped in with your tax. It all feels like it's part of the same thing.
Okay, so let's come back to the national insurance in a minute. Let's stick on the taxation bit first. So you have a personal allowance of just over £12,500. And once you hit that amount, then tax is due to be paid on monies above £12,500.
So £12,501 onwards, you pay 20% tax as a sole trader, as a self-employed person. So you pay 20% on that, on anything you earn up to 50,270. So it's a fairly standard, quite straightforward calculation. It's payable as a sole trader, not on your turnover, but on your profit. So if you turn over 30,000 and your costs are 20, your profit is 10, and you would sit in that personal allowance 0% band. If your turnover is, 70,000 and your costs are 32,000, whatever, I've left myself with really bad maths there. You'd pay tax on 37,000-ish or whatever the profit is. As a small owner-director, you tend to take money under PAYE.
What do you mean by a small owner-director? Could you just clarify that?
Okay, so if you run a limited company, some people choose to set up, so I did. I set up as a limited company to start with. main advantage of that is that there is no personal liability to me. Anything that happens, I can't be sued for. I would think most people in your world have professional insurance that covers that.
So most people, I think, are service-based providers that are self-employed and are running their business as a sole trader. So on that basis, they don't have any PAYE as such. They're just looking at their personal allowance and then the income tax brackets.
Yeah. And so it's the thing to remember is it's on the profit, not the turnover.
So I know that there are big brackets for higher up, which has just been changed at a recent budget. But I think once you're getting over the 125,000, which is the new top tier, I think you're probably on another level. So you'll probably have an accountant.
You've probably learned quite a lot of this by then anyway, just on the way past.
Yes, yeah. Agreed. So with regards to key tax dates, so the key tax dates that people need to know about when they are self-employed would be the 31st of January and the 31st of July. Those are the payment dates. Is that correct?
Those are the ones that you actually have to stump up the cash and pay the tax over. Yeah.
The other date that I find quite curious is the actual tax year, because that runs from the 6th of April from one year alongside to the 5th of April the following year. What is the reasoning behind having an April the 6th? Where does that come from?
It's a really old story. So back in the way back whens, in the 1500 and something, we went from one calendar to another. And we changed and we ended up with the current Gregorian calendar that we have with 365 days. But you paid a tithe to the Lord of the Manor 6 weeks after the beginning of the year, which happened to be in April-ish. So when they changed the calendar over and rather than pay tax in the April and then have to do it again in the January, so you only got 8 months in that first year because of the changeover, they just went, no, we'll keep it the same date. So it ended up on the 5th of April.
I just find that bizarre that we haven't moved on in the 21st century and that we're still accounting in the UK from the 6th of April to the 5th of April. It's just such a random date.
But the taxman isn't going to go, no, don't worry, let's do a year and a half to the following January. And we're not going to go, let's only do 8 months and pay full tax to the 1st of January. So, and actually it's quite nice that it's away from Christmas. Can you imagine having to do all of your tax return and everything like that by the 31st of December?
Well, there were 30,000 people that did actually submit their tax return between Christmas Eve and Boxing Day last year. 30,000 people. Did you know that? I cannot think of anything worse than pouring over your tax and your spreadsheets rather than actually pouring gravy over your turkey.
So I have 3 clients who phone me at that time of year because they go into the study and the instruction outside is, Grandpa's working, don't go in there. And it's basically for peace and quiet. And they phone me up and they go, at least this way I can pretend I'm not lying.
They're ringing you on Christmas Day to do their tax return. Stop it.
No, they ring us between Christmas and New Year. We get about 3 or 4 messages on the answer machine. We're closed between then. But yeah, because their Grandpa's working, and which roughly translates as he's had enough. And he's hiding.
Well, there were 30,000 people that weren't enjoying Christmas last year and they decided to do their tax return. So I think that's quite funny. Okay, so we've got a tax year that's running from the 6th of April to the 5th of April. And then we've also got a filing date of the 31st of January. So you have to get all of your tax information in to HMRC and submit it on or before the 31st of January. That's correct, isn't it?
Yes, it is. Because you actually have to pay your first tax bill on the 31st of January. Something that is actually really useful to remember as well, though, or to be aware of. When you first start up and you do your first return, you pay your current year's tax, and then you pay half on account against the next year's tax. So your first tax bill can be a really brutal double whammy. Just be warned, basically.
I think that's such an unfortunate thing for new starters because they're already just finding their feet, getting used to submitting a tax return, finding out all of the different things that they do when they start a new business, and to then have their first tax bill where they have to find effectively 1.5 times. So they pay 50% on account, presuming the taxman wants you to be in credit for the following tax year. It just seems a topsy-turvy way. Yeah, I find that really astonishing.
Brutal. particularly since, if you've only done half a year and you've got all your setup costs and everything else, and you happen to, by chance, in the last month have done whatever it is that makes it so, suddenly it's like, oh, by the way, we're having all of that and a bit more. Yeah, it is savage.
Yeah.
So you pay, what happens later on in the year? So January the 31st, once you're established, you pay half on account. So in your first year, let's say your tax bill's, I don't know, £2,000. You pay your £2,000 for that filing up to that 31st of January. And then you pay another £1,000 to cover the period from January to the 31st of July against what they think you might earn. And they base it on the previous years. So then when you come to July, you pay the balance of what they think you should pay for that year. And then when you come to January again, you do the whole payment on account. Anything that's left over, and then a payment on account.
Yeah, so it's only the first year that you have to pay that 1.5 times, and then you will pay your annual tax liability, and that will be split equally over those two payments on the 31st of January and the 31st of July. Yeah.
Yeah. It's mostly so that the taxman's in credit and you're not.
Yeah, no, I get that. So what we have done in Pocket PA, we've created a small tax estimator tool so that if you're regularly putting your income in and your expenses, because obviously it's only based on your profit, there's an option for you to have a tax estimator, and you can set it at either of the two defaults, which would be 20% and 30%. And if you don't want a default and you've got historic tax information and you work out that your average tax is, 24% or whatever based on your level of income, you can override it and put that in. But what it will do is tell you, if you look on it every single week or month, it will tell you what to set aside based on your set default, how much you need to set aside into your account to put towards your tax bill, and then what your pot should be overall for your tax year of the 6th of April to the 5th of April. Because I think we're all so busy and we see money going into our account and it's just like, yeah, I know I've got to put some aside for the tax man. But unless you actually have a goal or a marker to actually give you that sort of headline number, it's just a matter of trial and error. And people often are just so busy, they don't have that time to think. So a diary note to self, look at your Pocket PA, work out and see what it's suggesting you put it aside on a Sunday night or whatever day it is, or look at it on the month, and just know that it's in your account is such a prudent way as a business owner to go, I feel.
It's the most brilliant thing. There is nothing worse than getting to the end of the year and them turning around and going, by the way, we'd like £4,000, £5,000, £6,000, whatever it is. And you're going, I don't know where it is. Because what happens naturally is that, we put some money aside and we do stuff, and then there's an emergency or a big month or I need to pay the bills. So you pull back from the business and you don't keep leaving that extra bit in, and it can be brutal. The other really good thing to do with a dashboard or something like that, like there is on the Pocket PA, is to go in when you've done about 10 months of the year, because you then know roughly what's coming in the next 2 months. So you know roughly what your tax bill for the whole year is. And it's at that point you can do something like we talked last time about paying into pension to get rid of tax. You can't do it after the end of the tax year, but you can do it in that window at the end when you know roughly what you're going to earn for the year. You can get rid of your tax quite
efficiently.
Yeah, pretty efficiently, and keep the money yourself. Don't give it to the tax man. I don't mind giving the taxman a certain amount, but not so much.
Yeah, and I think that's the thing. It's about, if you're cautious or you want to make sure you've definitely got enough, you set your percentages a little bit higher. If you want to sell a little bit closer to the wind, you could set it lower. But the point is, you will have a pot of money to be able to put towards your tax bill. And if there's surplus, then hooray, you've got some for a few drinks to celebrate. And if it's a little bit short, at least you're only a small amount short compared to if you were in the dark and you weren't even short at all and hadn't been making any provision.
And there's nothing worse than waking up or seeing what your bill's likely to be and thinking, where am I going to find that from? So yeah, that's a brilliant feature. Yeah, fantastic.
And so one of the other things that I like to talk about with taxation is about when people talk about maximizing their profits, and the other thing I hear people talk about is minimizing their tax bill. Now, nobody is suggesting that anybody should illegally avoid paying tax. However, there are different times when you might want to show more profit in your business and put through less business expenses. For example, if you are thinking about applying for a mortgage and you want to have a track record, you want to just make sure that you're obviously maximizing and showing the most amount of earnings and your profit is at the largest in order for the lender to be able to see that you've got a profitable business. So could you just talk a little bit about how people can do that without obviously evading or avoiding tax in an illegal way? What would your comments be on that, Jess?
It's a matter of what you put through or not. So, if you want to minimize tax because you don't need to generate an income against a mortgage lending or anything like that, and you are literally trying to pay the least tax you possibly can, then you put through absolutely everything you possibly can. Rental space, if you're mobile or work from home, there are percentage allowances that your accountant will put through. You can put through
all of your travel and your business mileage, all of your phone
subsistence. If you go on a training day, you can put through your sandwich and whatever else at lunchtime, whatever it is like that. Absolutely everything. And you'll find that your costs therefore are much. Your costs will be higher than not, and the amount that you then pay tax on the profit will be minimal. If you are coming up to looking for a house or something like that, where you want to buy or move, it makes sense to have. So what mortgage lenders like to see is a profitable business that is growing. So if you've done, the pay as little tax as possible forever, it's often really useful to show in the following year that your business is growing and your profit is growing. So it may be that actually you just don't put through all those subsistence or all those small mileage claims and things. You just go, well, do you know what? I'm actually going to suck that up to a point because it'll show a bigger profit, and you can then borrow whatever it is, 3.5, 4 times against earnings. Different lenders will lend different criteria depending on how old you are and what you're buying. But if you can show a higher profit, then you can maximize what you're going to borrow, and you can always the following year afterwards minimize it again. But if you can show 2 or 3 years growing earnings, that absolutely lenders will go, yes, you're doing well, your business is growing and thriving, you are a great person to lend money to.
Yeah. So could you just run through for a self-employed business owner when they're just getting started, when they've got that registration date? Because I think the 5th of October is the self-assessment registration. I know it can be done at other times, but HMRC like you to have registered by the 5th of October if you've set up a new business. What are the steps that a new business person might need to go through when they're registering their business?
So you literally go online, Google register a new business. The HMRC websites are really clunky, but they're always very well named. It says hmrc.gov.uk/register my new business. And they'll take you through a decision tree and a wizard that just says, here, tick this, tick that. It used to be, or it's the 5th of October, because it used to be that if you were doing your own tax return, or if you were sending it to them to calculate, you had to do it by the end of October. So if you registered by then, the date's just tied in. You used to be able to send all your information to HMRC and go, can you calculate my tax for me, please? Rather than get an accountant to do it. But you had to do that by the end of October rather than the end of January.
And we hear a lot in the press these days about MTD, making tax digital. Now, at the moment, my understanding is that is only in place for VAT registered businesses. So if you are a VAT registered business, you currently have to go through what they call an MTD compliant software. However, there are plans afoot to bring that into the self-employed market. But at the moment, I think the date is April 2024, but they're looking at pushing that back potentially. I know it's been moved a couple of times already, or whatever.
It's been moved a couple of times, and I think it's on a bit of a sliding scale depending on how long you've been in business and it's going to affect people at the other end of the scale rather than a startup first.
Yeah, but it's nothing anybody should be sort of panicking about at this stage. It's not affecting the Joe Public general self-employed people at the moment. It's for those VAT registered businesses that have to do that sort of thing. I think it is a good marker, though.
It's something to be aware of, though, because it will come to everybody.
Yes, I was about to say, I think it's important that you have it on your radar as a small business owner and know that we are moving into digital times, and that the days where you might have things written down in a book, excuse me, or a paper diary or any of those sorts of things will be coming and drawing to an end. So it's important that you think forwards to know that you are going to be needing to put things online into a digital space or a tool.
And it'll then be, and instead of the once a year assessment, the intention is that it'll move to rolling quarters. So rather than paying a big bill twice a year, it'll just be a rolling quarter, a bit like VAT is now. You just pay a smaller amount more often, which in cash flow terms has got to be a good thing.
Little and often, as it were. Yeah. Now, let's just touch on briefly a little bit about potentially the penalties if you are to file late or to pay late. I think that there's a little bit of grace to enable you to have 30 days if you haven't quite paid your paying late. There isn't a penalty, but I think between 30 days and 6 months late, you have 5% of your tax bill is charged. 6 to 12 months after that, it's 10% of your tax bill. And if you're later than 12 months, it's actually 15% of your tax bill, which is a lot of money. There shouldn't be any reason that you need to do that, because it shouldn't come as a surprise, I feel.
Those penalties are also subject to interest, daily interest. So it mounts up really quickly.
The dreaded interest.
And there isn't really any reason why you can't do it. Submit something. If it's not absolutely perfect, submit something, because you can always kind of sort it out.
Yeah, sorry, those were late paying fees. The actual the fees for submitting your self-assessment late is if you're between 1 and 3 months late, there's £100 flat fee that you're charged for late submission. There's a £10 per day between 3 and 6 months late, and there's a £300 flat fee or 5% of your bill, whichever is the greater, between 6 and 12 months. And the same after 12 months. So yeah, there are late payment fees and also late fees for submitting your self-assessment. So I think it is really important that you have to take it seriously.
You do, and just, it's not, it's one of those, oh my God, it's terrifying, my tax return must be, and if you're in your first year of business, if you don't get it exactly perfectly to the absolute ounce of a pence right, it's okay.
Yeah. The head won't be chopped off.
Put in the best option that you possibly can, because like so many things with the revenue, provided you've shown willing and are doing the right thing, they will help you untangle something. If they think you're taking the piss, for want of a better expression, they can be quite harsh.
Yeah. So could we just also go back now to the national insurance contributions? So I think we've covered all the taxation part for the thresholds, etc. So again, the national insurance, you mentioned and touched on the fact that it can be a contribution, and if you're not reaching a certain level, it could still be a good idea for people to top it up. Could you just explain a little bit about why that might be?
So national insurance basically is split two ways mostly. It goes into the basic state pension, so it accumulates your entitlement to the basic state pension, which is currently £9,500 a year. But you have to have X number of qualifying years where you pay a national insurance or pay stamp. You might have heard your grandpa call it, have you paid your stamp? Because you used to get a stamp. And it sits alongside your income tax, and it will be calculated when you do your submission. It will show you there. The thresholds are quite low. So the lower earnings threshold is, hold on a moment because I don't carry these in my head, £123 a week or £6,396 a year. So you don't pay anything if your earnings are below that. It is worth paying the voluntary contributions because they're worth £140 a week. State pension's £185 in total per week. later. But you have to have accumulated those payments. So if you don't reach that in your first year or your second year, again, pay the either pay the class 2 that sits alongside being self-employed, which is it was a flat £200 last year. I think it's the same. It is, yes. Otherwise, if you only pay a partial year, when you come to claiming your state pension at the other end, you don't qualify for it. If you're coming up to claiming state pension age, or you've worked a bit like that part-time all the way through your life, again, government website, check my state pension. They really do give them just the best names ever. And you can put in your gateway and your national insurance number, and it tells you have this many years, this many qualifying years, you need to pay for another X number of years. And just be aware of it, that it feels great not to pay it, but actually in terms of pure investment, whatever you pay, you get your money back in about 3 years' time once you start claiming your state pension. So, and in yesterday's budget, they put the triple lock of a 10% rise on it.
Yeah.
Fabulous.
And the last thing that I wanted to just touch on was that if you are thinking about starting a business, or you are newly started and you're moving your hobby into sort of business mode, there is also sort of a flat £1,000 trading allowance. So if you have a side hustle, it means that you could earn up to £1,000 without there being any tax implications as a sole trader. That's 1,000, isn't it? That's right, Jess.
I want to say yes, but again, yes, I'm going to say yes.
Yeah, I think I looked it up this week actually,
because I'm sat there thinking that's accountant world, not my world. But yes.
Yeah, no, it's fine. I think I did a TikTok video on it, I think the other day, or something as daring as that.
I'm just frantically going down the list of the tax tables, and it's like, yes, you are. It's right, yes.
But I think it's just great that you could get started and dip your toe into the water, and as long as your expenses aren't too high, if you can't be bothered, getting started in that way and making it totally official, you could get started and see how it was. Up to £1,000 is that trading allowance, so there is a little bit of a leeway and a runway into actually before you need to start really being diligent. But I think that's enough of a leeway to think, gosh, yes, I have taken over £1,000 now, this could be a viable self-employed business in order to move on to that stage.
And then it's just how long did it take you to take the £1,000 is where it becomes, is that viable or not?
Yeah. No, that's really interesting. Do you think, is there anything else that we should be covering on this podcast, do you think, Jess, today, or do you think that's enough bamboozling of numbers?
Tax, it's one of those, it pretty much, like you say, if you put a percentage of either 20, 25, 30, there or thereabouts across every single week, if you just go to the end of the week and go, I've taken this much, put 25% to one side, you'll be covered. You won't have that big surprise horrible bill. It's the people that put Zippo and don't make any preparation and then imagine that it comes as a massive shock at the end. It isn't. It doesn't need to be. It shouldn't be stressful. Taxes don't need to be taxing. It's a known quantity. We don't have to like them, but we all do want the the repercussions of being able to use our NHS service. We want to have police on the streets. We want all sorts of other benefits, roads that work, all those things. Yeah. Side. So unfortunately we have to balance the book somewhere, and for those of us that are earning money, if you have a big tax bill, it probably means you've earned quite a bit of it's a fabulous thing to have, isn't it? I mean, it sounds awful, but it's an amazing thing. If you've got a massive tax bill, you've earned an awful lot of money. Hooray! What's that to like? Yeah, it doesn't make the pill any less hard to swallow, because it does feel. But I think, I have a feeling where I try and reframe it and look at thinking that I'm paying into society, and, I'm paying for nurses, I'm paying for doctors, I'm paying for all of these things that I do want to have access to. So I feel that it's a good thing to be. I love that, but you're also far more worthy than I am, because I just think, hooray, I've got to pay £10,000 in tax this year. Woohoo! How much do you think that means I've earned? So I'm not nearly as good as you. Sorry, Caro. Far more capitalist and selfish. Not funny how we think of things differently. Oh dear. But it's the same thing. I had a client come in just now who said, I don't want to take that. He's got a pension money that's going to pay out to him automatically. He said, I don't want to take it because I'll have to pay tax. I'm like, £80 of something is better than nothing. So if you earn £100, and you're going to get 80 of it, then isn't that £80 better than nothing? I mean, why would you not?
Yeah, it's funny how people reframe things, isn't it? Oh, thanks so much, Jess, for sharing all that with us. If our listeners would like to find out more about you and to connect, where is the best place for them to find you?
So we are Bare Naked Money. Actually, on the back of this, which will link very well with the Pocket PA stuff, I have a freebie in my Bare Naked Money profile that is about the 3 numbers that you need, and they're purely about tax and how to then work out your tax things. So, and you could get them all really easy from where you're putting numbers into Pocket PA. So, Bare Naked Money, Facebook, LinkedIn. I'm under Jess Walker, I think, still, but Bare Naked Money's the place to find.
Lovely. Great. Well, thank you for joining me this week, Jess, and thank you for listening, everyone. I hope you have a wonderful week ahead and lots of lovely money with the least amount of stress. And until next time, let's catch up soon. Thanks for listening to the Earn More, Stress Less podcast with me, Caro Sison. If you've enjoyed this week's episode, then do hit subscribe so we can catch up again soon. And please kindly leave a review if you've got a moment and share with anyone else that you think this podcast could help on their self-employed journey. If you're ready to make bigger breakthroughs in your business life and want to get way more organised and understand your finances the really simple way, then start your very own 14-day free trial today using the super powerful software tool Pocket PA that I made for my own son and daughter. Go to pocketpa.com/podcast and let's get you on the way to earning more money and stressing much less. Have a great week, whatever you're doing.